Hey, good afternoon, everyone. It's Tim here. We're going to do this video here before the close because I've got to run to Oklahoma City to pick a kid up from a basketball camp. But wanted to get this out to you timely so you can see how the market's reacting to the report that came out at 11 and kind of what we're viewing. How we're viewing things. So you should have seen an email come out a little bit ago that talks about corn. That's the one that I'm really most intent on. I think beans are fairly easy to look at. I think corn's a little bit more complicated. So let's keep things simple and let's keep things clear. Here's the deal: if we burn up Iowa, Illinois, and Indiana, then the corn market's going to go higher and it's going to rally. But as we've said before, it's not going to rally to 575 or 6 in that event. It's going to go way up higher and it's going to blow through old highs, and we'll be trading somewhere north of 850. But in order to get there, here's what has to happen first from a fundamental standpoint. First, we have to have demand come back into the picture. Second, we have to take our national yield somewhere below 163 in order for us to really start to shrink this balance sheet. And I'm not going to spend the time in this video to get into that, but here's the deal. The USDA today is telling us that the corn carryout is 2.257 billion bushels. And that's with a 181 yield, and that's with demand being relatively high, because remember on the May report they actually increased demand by about 650 million bushels. So they increased demand and left yield high. And we said at the time, we think that that's really bearish longer term, because if demand doesn't pick up, then they're going to take all of that away plus some, and we're well below that right now. So that's a way that they sandbagged the yield argument. So they can actually decrease the yield, decrease demand, and maintain this carryout where it's at. And if we have a 2257 carryout, we're not trading $6 corn or 8. We're trading somewhere 450 to 375. Okay, we're going to be much lower than we are. So in order to get that carryout down to 1.5 or lower, which is what we need for higher prices, we have to get actual shipments and actual demand up, and we have to see that yield come back down. I don't see any other way for that to happen. Now, the weather forecast, let's talk about whether those are bullish or bearish. It is no doubt that we're behind on soil moisture in critical growing areas, okay? And what we've been talking about here in the office is that this weather issue is a little bit different than what we've dealt with the last couple of years. In the last couple of years, we've had a lot of dryness in areas that are relatively low yielding, like North Dakota, South Dakota, right? The yield potential there just isn't as high as the yield potential in Iowa. Okay, so it takes a lot. So if you lose 1 million acres of North Dakota ground, it's not the same impact as losing 1 million acres in Iowa. All right, so if it's super dry there, Iowa out yielded the losses in those areas. Now we're looking at kind of the reverse. It's getting drier in the critical areas and better in the less critical areas. So those fringe acres can't make up the difference if we start taking yield off of the I states. So that's why corn is so much more important in our mind than anything else, because that's where a lack of bushels really starts to make a difference. Now, if that's going to happen, then it has to actually burn up. And right now, the weather forecasts are actually calling for cooler than normal temperatures with average to slightly above average precip in the coming weeks. So there's a good shot of rain this weekend, and then moving forward, it starts to look a little bit better moving into pollination. So those of you that are used to farming in desert conditions know how well corn can perform with stress followed by moisture, right? So the yield potential is still there, which is why we want to be really hesitant to jump in too early and lift hedges or put on too much reownership, okay? Now, so let's look at corn here first. Let me pull up new crop corn and show you exactly how we're monitoring it, okay? So here is, on this side, this is the daily chart. Here's your 240 minute, and here is your 500 or 60 minute chart. Okay, and you can see where we were when the report came out. We're trading slightly higher, but not explosive. And we were trading like 526, 527 when the report came out. We're now trading 530. So really not a whole lot to write home about in this report from a technical standpoint. So let's make it bigger picture and think long term, not short term, okay? Because that's where your risk lies, is in the long term, not here and now, because this crop has a long way to go before it finishes. We think that 550 is the critical pivot point. We're currently trading 530. I want to make this super simple. 550. Look at this line that is on the chart. Okay, it goes all the way back to last September, last July, and it's a lot of chart support and resistance. We've broken it to the downside. We've now rallied back and tested it. We have failed to break through it. We think that that's the critical level. And remember, I think that this is too big of an issue weather-wise to worry about absolute pennies. 540, 555, 563, we're not worried about that 20 cents. What we're worried about is if it breaks higher and really does get going, then we're going way up above the old contract highs. So I want to be really patient, because if we're right and the weather does turn, then we're going way below these contract lows. So think of this as a range, okay? Somewhere in here, if we start trading and closing above that with bullish forecasts, then we need to get long. That's our pivot point. 550 is a nice round number. It may take a few weeks for us to adjust to that. I'm not thinking about a day or a time frame. I'm thinking about a pivot point, which is 550. And above it, we want to get pretty bullish. Below it, we want to get really bearish for this year and next year and the year before, right? So remember, everything I'm talking about here is designed, and I'm trying to articulate how we want to manage your farm risk, because ultimately that's what you pay us to do. And we're not worried about higher prices as much as we are about lower prices. Now let's talk about production risk. I know we have a lot of dry land, and I know we have a lot of people worried about it. So from a production risk standpoint, if you're hedged from these higher levels, you're okay. At that 550 pivot point, you're still okay. We'll come out of hedges. We'll get reownership on. We'll be talking to our third parties that are holding those bushels, and we have delivery obligations for, communication. That's what we have to have in order to handle non-deliveries, right? So I'm not worried about that at all today. What I'm worried about is not being hedged enough if we roll over, and we do end up with a 2 billion bushel corn carryout. And I don't think we can articulate that loudly enough or often enough. That corn carryout is lower, and it takes a long time for us to chew through all that new supply. We got to generate new supply, and we got to generate new demand if we take down into lower prices. So we want to be hedged, and I want to be very careful to not let these higher levels slip away from us. So we are going to watch 550. We are going to pay very close attention to it. If we start to break and close up above it, then we're going to get more bullish. No question about it. Technically, what else happens? Well, we break through a lot of natural chart support and resistance, right? This is a big deal. What was once support is now resistance, and if we break back through it, then it now becomes support again. So that will change our bias inherently bullish. We will now be above our cloud if we're above 550, right? Our top of our cloud today is 555. In 2 weeks, it's down here at 536. We start to get above our cloud, and we start to get up above that chart resistance, we're going to turn bullish. No question about it, because that's what we'll have to do, and that's the chart now telling us your risk is now to the upside, not the downside. If we break up through it and then reverse from it and come back through, we'll stick with it, and we'll keep our hedges on. We're going to take it a day at a time. We're going to take this range, we're going to take it in stride. We're not going to over worry about it. We're not going to over trade it because the risk is lower until we get some type of confirmation that our yield is under 163-ish, and our either our acres are coming down or our demand is shooting back up. So I think corn is the hard one to trade, but it's 550 that we want to be clear about. Okay. Now let's look at soybeans. Let me put this back so you can see how they're trading as well. Let's go to new crop. Oh, that is new crop over here. Let me get it to the right screen so you can see the shorter term stuff. Okay, so here is new crop beans holding the $12 level. Right before the report, we traded up to that. We then traded right back down below it, and now we're trading up. This is the report bar. We were trading 4 or 5 cents from where the report came out. So again, not a huge surprise there. The USDA says that our soybean carryout ending stocks are going to be 350. The trade was looking for 340, so maybe a little bit bearish there, but we're not getting like a screaming high reaction here either. So from a soybean standpoint, it's too early to burn those up. The forecasts are much more friendly to bean production. I don't think we're going to get into big bean problems, but like corn, what pivot points are we looking at? Where do we want to be defensive and really turn bullish? Well, we were looking at 550 on corn. Let's keep it super simple, and let's look at 1250 on beans, right? 1250, maybe even as high as 1288. Remember, beans are the same as corn. If we collapse our carryouts to below where we were a year ago, then we're not going to stop at 13. So this is not our risk. Our risk is $18, $19, $20 beans if we keep getting tighter and tighter and tighter and the global supply shrinks. All right, just like corn goes way past 650 if that were to happen. But to get there, there is an awful lot of heavy lifting and chart resistance and support here that we've got to get through, and it starts at 1250. So if we are looking at this objectively, we want to make sure that we are careful not to lift our hedges or get too extended too soon above this range, or before we get up through this 1250 to 1280 range. Okay, now you're like, hey, that's 80 more cents. Yep, that's okay, because if we do get rains and this thing rolls over, we're talking about sub 11, 1050, maybe even beans with a 9 in front of it, just like corn can go way lower as well. And if you're reading people that say that can't happen, they're wrong. Anything can happen in a market. We can go to 20, we can go to 2. Oil went negative less than 3 years ago. Don't forget that, right? Anything can happen in a market, and your job as a producer is to be is to accept that as fact and then manage your risk accordingly. So as a spec, this is starting to look not too terrible as a spec. But with all of this stuff up in here, your risk reward is still lower, so it's going to keep us out of being speculatively long because there's just not enough to gain. We're running the risk of a huge down move into a potential gain and resistance zone of maybe 30, 40 cents. It just doesn't make a whole lot of sense for us from a risk perspective. So even though we're working a little bit higher today, and even though we're holding the $12 range, we don't want to rush in and be big buyers here until we get some sort of other catalyst. If corn gets rocking and rolling, beans will go with it probably. If the weather forecasts turn hotter and drier out into the deferreds, we'll probably go higher. It's really that same situation, right? You got to grow the crop in order to sell it off. So I'm not worried about this action. In fact, I kind of like that it's a 3-wave move off the bottom right up into the bottom of some prior support zones, and I would look at that as fairly bearish. Now I want to show you old crop beans here too, because they're really rocking and rolling today, right? They're up 20, 25 cents, but from the time the report came out, they're up 3. So there's not a whole lot of bullish reaction to this report, but there's not bearish reaction either. It was just a wash. And if you look at this chart from a longer term perspective, what we're seeing is some exhaustion on the shorter term charts. This is 240. This is 60-minute. We're starting to see some exhaustion there. We're starting to see a 3-wave move kind of end. We had these 3 big long upper shadows right here. You can see those on the mouses, and now we've blown up through that and ran all the stops that were up above here, and now look at where we are. We're sitting right on the bottom of this giant shelf that has support all the way back to last August. So this is a tremendous amount of resistance, and in my view, an excellent spec risk reward, because you can sell it and look to much, much lower values, and you can sell it and have a very clear exit point here at 14. You know exactly where you're wrong. You know exactly where you've got to get out. And so for me, it's a no-brainer. You sell this below this level. Obviously, that's not a guarantee. It has risk. I think the stop's got to be put near 14. And you got to be cognizant of what's happening in the weather too. But reality is, I don't think that that we're justified in a big up move, and I think we could probably take all this $1.25 back or whatever pretty dang fast. I think that this could come off in a day or two, or maybe 3, if this trade decides that it doesn't need to be higher. So I think beans are a great short at this level, and something that we'd be looking to do in spec accounts. Okay, that's 15 minutes. Oh, wheat. Sorry, Brandon, I meant to do wheat just for you today first, but I completely spaced it off because the report was more geared towards the other ones. You know, it's funny. Some of our big wheat growers think we spend way too much time on corn and soybeans. Most of our big corn growers don't know why we even talk about wheat. So it's a little bit funny to hear you guys talk about it. Here is your July wheat contract. You know, I think that this thing is behaving horribly. Wheat actually had a tighter ending stock at 598 versus the trade estimate at 605. So its report should have been a little bit bullish. It's not. It just keeps struggling and testing at this 8 to 825 level. This thing is extremely wicked to trade because it is being so heavily manipulated by the war and Russia and all that stuff going on. But from just a pure supply and demand standpoint, I don't see the reason that we got to go way higher in wheat. If we're going to go higher, it's because of just future uncertainty, and in order to get back long, we got to see something back up above 850. If you're super aggressive, 811, 820, somewhere in there would be an entry. Otherwise, I think we're just looking lower. And how much lower could we go? You know, these targets count down to the 6s, right, pretty easily. So we're bearish wheat, we're bearish corn, we're bearish beans until something like price action forces us to come out of that position and look higher. But we don't see that in the cards as of yet today. All right, that's a long video, 17 minutes. Thank you for sticking with us. Again, we take it very, very seriously that we want to manage your risk and be cognizant of your downside. I love to be bullish. I much prefer higher prices. They're a lot more fun to trade. They're a lot more fun to manage. But I would be intellectually dishonest with you if I thought if I were telling you to be just a crazy bull, because the technical setup and the fundamental setup are just not pointing that way to us at the moment. So we've got to stick to defending that balance sheet against lower prices. Remember, there is significant risk trading futures and options, and you should only do so in light of your own financial condition. Trading futures, it always has a risk of loss, and you can't manage that loss. You can't take that for granted. All right, have a great day, guys. We'll talk to you next week. See you later.